Alphabet just spent $69 billion in a single quarter on infrastructure and a secret acquisition. For your portfolio, this signals a radical metamorphosis from a capital-light software giant into a high-intensity infrastructure utility. Notice how the 7% post-earnings surge suggests the market is celebrating. But is this a justified repricing or a massive overreaction? Can a company truly grow its profits by 82% while its core business model faces an existential threat? The headline suggests yes, reporting a diluted net income per share of $5.11. Earnings per share is simply a company's profit divided by the number of shares held by investors, and it serves as the heartbeat of most valuation models. However, as a sophisticated active market participant, you must look at other income, which hit $37.7 billion this quarter. Nearly 46% of pre-tax income was actually a $36.9 billion unrealized gain on non-marketable equity securities. Think of it this way: these are paper gains on investments Alphabet hasn't sold yet, meaning they don't actually put cash in the bank today. Once you grasp this, you'll realize that stripping away these volatile gains reveals an adjusted earnings per share of approximately $2.76. This is a classic example of why fundamental analysis is so critical for your investing strategy, because it allows you to separate accounting noise from operational reality. Why did $33.6 billion disappear from the cash flow statement for acquisitions without a single explanatory sentence from management? This massive acquisition anomaly led to a $24.4 billion spike in goodwill on the balance sheet, dwarfing almost every historical tech deal in existence. Goodwill is an intangible asset that appears when one company buys another for more than its fair market value. While the market initially ignored this silence for your positions, this lack of transparency is a primary driver of long-term skepticism. It suggests a stealth consolidation of the artificial intelligence landscape that regulators have not yet fully scrutinized. This $33.6 billion mystery represents a massive chunk of shareholder value being deployed in total silence. Always remember that when a company stops talking about its largest ever expenditure, the strategic risks are likely escalating behind the scenes. Why did Alphabet choose to abandon its most loyal shareholders by reporting exactly $0 in share repurchases this quarter? This is a violent pivot from the $15 billion spent on buybacks just 1 year ago, marking a total shift in how the company treats its excess capital. Buybacks occur when a company uses its own cash to purchase its shares on the open market, effectively increasing the value of the remaining shares for investors like you. This suggests that management now views survival in the technological arms race as more vital than supporting your immediate stock price. For your portfolio, this means the safety net has been removed to fund a defensive perimeter costing $35.7 billion. While the board declared a 5% increase to the quarterly dividend, bringing it to 22 cents per share, this is a mere peace offering. The dividend cost of $2.5 billion is small compared to the $59 billion boost to retained earnings. As an investor, you must realize that Alphabet is transitioning from a shareholder-first growth engine to a reinvestment-heavy industrial giant. Can the business truly sustain a capital expenditure rate that has surged to $35.7 billion in a single quarter? Capital expenditures represent the money a company spends to buy, maintain, or improve its physical assets, like servers and data centers. This represents a 107% increase year over year, driven by the desperate need to own the hardware layer of the future. This aggressive spending caused free cash flow margins to collapse from over 20% to just 9.2% in a single year. Free cash flow is the actual cash a company has left over after paying for its operating expenses and capital expenditures. The era of easy, capital-light growth is officially over, replaced by a cycle of massive, recurring hardware investments. This is a simple rule, but it's incredibly powerful. You are now investing in the steel and silicon of the internet, not just the code. Is the narrative that the core search business is dying officially debunked by a 19% revenue growth rate? Google search and other revenue reached $60.4 billion this quarter, with query volume hitting an all-time high despite the rise of generative competitors. Total consolidated revenues across the firm reached $109.9 billion, a 22% increase that proves the search engine is still a dominant cash cow. Notice how this resilience is the only reason the company can afford its $41.3 billion cost of revenues. This 19% search growth is the engine powering the $41.3 billion operational machine. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that, noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.